Hi there. Welcome to Trading Day. I'm Lindsay Biscaya. Let's get to some of the stories we're following for you in the BNN Bloomberg newsroom. Prime Minister Mark Carney says Canada has what the world wants and is an energy superpower. He is taking his message to New York this week, where he'll meet with investors, CEOs, and business leaders. Carney will deliver remarks at the Economic Club of New York on Thursday. There, he will provide details on Canada's new economic strategy. And the price of oil is moving lower as the U.S. and Iran are nearing a deal to extend their ceasefire and reopen the Strait of Hormuz. In a post on Truth Social, U.S. President Donald Trump says negotiations over an interim deal were proceeding nicely. Meanwhile, a spokesperson for Iran's foreign ministry says neither side is ready to sign an agreement, but progress has been made on a number of topics. And Tim Hortons says it wants to hire more Canadians in a new campaign. It's doing so as the number of temporary foreign workers in its restaurants declines. The coffee chain says it no longer needs to rely on foreign workers amidst high youth unemployment. And we're keeping an eye on the markets today, particularly the TSX, seeing some gains to start this week, up by 0.9%, well over 34,000 points. And we'll continue to watch that for you. Meanwhile, though, the U.S. economy remains resilient, driven by strong AI-led investment. However, investors are facing re-accelerating inflation, rising energy prices tied to Middle East tensions, and the risk of higher for longer interest rates. So joining us to discuss all of this is Michael DeHaul, Senior Portfolio Manager at DeHaul Investment Partners. It's great to have you in studio once again.
Thank you, Lindsay. Great to be here.
So the U.S. economy grew 2% in the first quarter. That's quite a bit of growth. Business investment doing much of the heavy lifting. How important is the AI build-out in amongst all this growth?
It's really important. And most of the growth has come from AI investments, AI infrastructure build-out. Even the earnings growth that we've seen in Q1, it was 26% year-over-year earnings growth in Q1, largely with the AI build-out and the tech companies, right? So AI is definitely a tailwind for the U.S. economy right now.
For sure. We've been seeing, because speaking of that, we've been seeing consumer spending really starting to slow down. But on the flip side, obviously, a lot of businesses are spending more, businesses are investing more. What do you make of that? Is that a warning sign right now?
Consumers are cautious. The latest consumer sentiment numbers that came out last week in the U.S. was the lowest, I believe, it was in 3-4 decades. So consumers are cautious with the ongoing war, with the conflict, higher prices, obviously with the higher oil prices, gasoline prices, heading to the summer months where you got, more demand for travel and on the road and things like that, right? So consumers are a bit cautious. But on the flip side, businesses are still a bit upbeat. But they are cautious heading into the summer and into Q3.
Okay, so then it's not like a healthy rotation maybe that we're seeing right now.
No. Right now, even look at the markets, the S&P 500, we're seeing a tremendous rally since March 30th, lows to now. But we're seeing an increasingly narrow market. It's a handful of stocks, mostly in tech and the AI. That's been powering this rally higher. How
dangerous is that? If we're looking at the S&P 500 when it's really just a couple of different, companies, a couple of different sectors that are really powering that growth, it's not a healthy, diverse, market.
Yeah, correct. We want a broad market. A broadening market is a healthier market. Mm-hmm. When you see this narrowness in a market rally, it is worrisome because those handful of stocks can go the other way. And we can get, the opposite market moves in the markets, right? So, as investors, we want more of a broadening out market. This narrowness isn't really good for the markets, but hey, we'll take it for now.
Yeah, because we're seeing inflation pick up, right? In the month of April, it really accelerated, mostly due to energy prices rising.
Right. Yeah.
How concerned do you think investors should be and consumers just on seeing another inflation wave later this year if energy prices stay high?
Yeah, and in the near term, we do expect inflation to reaccelerate. on the back of higher oil prices, higher food prices. So, but we do expect later on this year in Q3, Q4, if the war does end or we do get some kind of resolution in the Middle East, that inflation could come back down to about 2%. But energy, that is a wild card for inflation and for consumer spending.
Yeah, because like how much of the market really depends on oil prices right now.
Correct. And mind you, if we do get if the Strait of Hormuz does open up, let's say tomorrow,
right,
it's still going to take 2 or 3 months for energy prices to go back to normal and stuff, right? So we do expect higher inflation over the next couple months, right? So that's why in the very near term, with this market rally we've gotten, we could see some near-term weakness going into, June and July.
The Fed remaining on hold for now. Do you think the market has kind of fully adjusted to the idea of higher for longer rates?
Yeah, you look at the 2-year U.S. Treasury yield, and usually the 2 years is an indication of where the Fed's going to be.
Okay.
The 2-year has been rising along with the 10-year. The 10-year hit 470 last week, and the 30-year U.S. bond hit a high
Record
since
highs,
2007. So bond markets are indicating higher for longer. Possibly higher inflation for longer, right? So it complicates the Fed's picture. But overall, right now, if you look at the U.S. economy, corporate profits are still strong. Labor market's still pretty robust. Unemployment's at 4.3%. So I do think the Fed could hold for the remainder of the year. But the labor market and inflation are two things that will be looking at.
Because we've also heard more about like a potential stagflation test for markets. What does that even mean, first of all, and what would that look like?
Yeah, well, stagflation is when you got rising prices and a slowing economy. Right? So when prices are rising and the GDP growth is slowing down, that's stagflation, which we do not want. That's where consumers will be faced with, higher prices and maybe job losses or slower economic growth, right? But you could have inflation if the economy's still growing as well, right? But if we get a fall off in economic activity in the U.S. and a slower economy, that's definitely stagflation, which no one wants a stagflationary environment, which we had back in the 70s.
And a stagflation test would basically be like how markets respond to that.
Exactly, and it'll be pretty negative if we get a stagflation
for sure
environment.
Earnings, obviously, in the last quarter, remarkably strong, particularly in certain sectors. I'll ask you about your takeaway of the latest kind of earnings group that we saw, but also moving forward when you start to see companies really pricing in the effects of what's been happening in the Middle East. Will that continue?
Yeah,
strong earnings.
Yeah, strong. As I mentioned earlier, strong earnings. We had the best earnings, I think, the last 3-4 years. 26% year-over-year earnings growth. Primarily, Nvidia, Micron were the key drivers of that earnings growth, along with other tech names as well. But if you look underneath the surface, Walmart reported last week they did have a cautionary outlook for the rest of the year, along with Home Depot and Lowe's as well. So going into Q2 earnings, we'll see more of the impacts of higher prices, inflation, and we could see some cautionary tales from the consumer names going into Q2.
I want to turn to Canada because obviously that's where we are, but also we're watching for a lot of the big banks reporting earnings later this week, beginning on Wednesday. Anything particular that you're watching for there or that you hope to see?
Yeah, we do expect earnings to be great, but given the run-up we've had in Canadian bank stocks and the elevated valuations we've seen up until now, the telling tale would be PCLs, which are provisions for credit losses. I think that's a swing factor. We know that capital markets, trading, wealth management, those divisions will pull up bank earnings for the quarter. But the key thing would be PCLs. So if banks increase or aggressively put aside more money for potential bad loans, that could have a negative impact on the bank's stock prices. But again, given the valuations where we're at, we are at a premium historically for Canadian banks. So the bar is pretty high for them to continue that run up in their stock prices.
For sure. Okay, we'll have to see how they do. We'll leave it there right now. Michael DeHull, Senior Portfolio Manager at DeHull Investment Partners. Appreciate you coming in. Thanks so much.
Thank you.
And coming up, Canada may not be losing talent in the same way it did in the 1990s, but a new report from TD argues the country is quietly exporting some of its best and brightest to the United States. We've got more on that when we come back. Stay with us. A new report from TD Economics says Canada may be quietly losing some of its top talent to the United States. It describes a silent brain drain with skilled workers, entrepreneurs, and STEM graduates heading south for better opportunities. U.S. visas, of course, and aggressive tech recruitment. So to discuss more, we sat down earlier with Francis Fong, co-author of the report and managing director at TD Economics.
This is not an issue that is brand new for Canada. It's one that we've been facing for quite some time. The reason we wrote this report, however, is to highlight the fact that, we're sort of in this moment in time right now with our relationship with the U.S. sort of deteriorating, us trying to sort of diversify our trading partners, to highlight the fact that we are still not really all that competitive. Our productivity growth is quite low and has been for a few years now. And so banging this drum about wanting to raise this issue around competitiveness, that was the goal of this. And in the report, we highlight the fact that our personal tax rates, relatively high income earners face extremely high marginal tax rates, in combination with a business tax architecture that can often drive entrepreneurs and business owners to pursue tax planning initiatives to try and lower that rate. And all that leads to an inefficient allocation of resources, low productivity growth, and the risk that we're obviously highlighting here, the risk that our high skilled talent leaves the country for better opportunities further ashore.
All right, let's talk about the tax. There's more than probably I imagine just the tax competitiveness, but let's talk about that. How different is it? How much of an advantage do the Americans offer when it comes to saving money? Yeah,
I mean, there's sort of two points to this here. One is just the actual tax rate and when it hits. So if you compare, Ontario, BC, and Quebec, the highest marginal tax rate rises above 50%. In Alberta, it's 48%. But they all hit at that top sort of federal income tax bracket around $275,000 or a little bit higher than that. Whereas in America, they might have equivalently high marginal tax rates in places like California or New York, but the levels of income that they hit at are far, far higher than ours, upwards of maybe $700,000 to $1 million. And we're talking American here too. So if you sort of equilibrate the income levels, the incomes that we're earning here where we're paying the highest marginal tax rate are comparatively relatively low. And so that's sort of the major issue here is that even sort of, high earners or what you might not even consider to be a high earner in America, they would, if you brought that income over here, they would be paying extremely high rates here in Canada.
And is there enough to convince government to give breaks, or is that something we can't see happening here?
So here's the challenge here is that it's hard to sort of just take high personal marginal tax rates as just standalone an issue that we can lower rates here. We have to sort of consider the fact that our business taxes sort of have these odd distortions that can create a disincentive for firms to grow. We often sort of refer to this gap between the small business tax rate, the sort of favorable tax rate that we offer small businesses below a certain size, as being really, really low relative to the general corporate income tax rate. So basically what happens is when a firm starts to grow, once they reach above a certain size in terms of income and asset thresholds, their marginal tax rate rises extremely high. And so as a result, you have business owners that pursue these tax planning strategies and sort of manage their affairs in a way where they can defer those taxes or lower their effective tax rate, which obviously salary earners don't have that opportunity. So there's a lot more issues than just high personal marginal tax rates, which is what we try and go through with this paper. But it's quite complex in that regard. And also one of the things you mentioned, productivity and scale problems. We're simply not big enough, are we? Yeah, and that's ultimately the issue. At the end of the day, there's the one side where our tax system might not be super competitive, but on the same token, the biggest draw for folks to the U.S. is really just the opportunity to earn higher. So all that argues that Canada has to be just that much more competitive for us to be retaining our top talent, our doctors, our entrepreneurs, our tech workers, so on and so forth, relative to the U.S., which is sort of this elephant in the room. We need to figure out some way of maintaining that. And that's also not getting into the sort of adjacent challenges related to, Canada's relatively high regulatory burden, our relative lack of venture capital and patient capital. All of these issues ladder up into the productivity problems that we face today. And have you talked to people who have left? Did you talk to anybody who left and say, hey, what would bring you back? Is there anything that they might be looking and go, you know what, we love Canada, but
Are there things that maybe would surprise people that might bring them back?
That's the trillion-dollar question, Roger. It's not something we unfortunately were able to do, but I certainly can tell you that this is something government is really focused on right now. What we're hearing out of the federal budget last year, out of the spring economic update earlier, there's a huge focus in this government to try and get firms to locate and remain here. Infrastructure is obviously where they've sort of put a lot of their eggs into that basket, which is ultimately a good thing given our infrastructure gap that we've been dealing with for quite some years too. But obviously it's just sort of one piece of the puzzle. And, there's still time yet to sort of see how this government wants to attack this challenge.
And this move, is it fairly uniform across the country, or are there certain areas being hit harder than others? Could you break that down at all?
Well, ultimately, I think this sort of points to the fact that we are a very north-south oriented country. So I don't think it's sort of one region gets hit harder than the other necessarily. But certainly it's the case that we're going to be losing, talented entrepreneurs to our closest trading partners statewise. So obviously Ontario and Quebec will lose it to New England. But we do see quite a lot of movement of Canadians to, basically lower tax jurisdictions and high growth states, places like Florida, Texas. Part of that is going to be, retired people just going down south. So, we do have to sort of present some nuance in the numbers that it's not all talent that's moving down there. It's retired people. But on the same token, we can actually say the same thing about what's going on in the US as well. You can compare high tax states like California and New York, and they are equally losing people every single year to Texas, Florida, and other lower tax jurisdictions. So the same sort of tax playing, if you want to call it that, it exists down there as well, and we're just sort of part and parcel of that larger story.
That was Francis Fong, co-author of the report and managing director at TD Economics. Up next, a new report is highlighting the shifting trade situation for Canadian exporters, and we take a look at whether they are prepared for the current landscape right after the break. Stay with us. According to a new Deloitte report, Canadian exporters might be facing a trade shock caused by a lack of diversification and over-reliance on the U.S. For more, we sat down earlier with Jim Kilpatrick, Global Supply Chain and Network Operations Leader at Deloitte.
In 2025, what really was perceived as a tariff-related trade shock for Canada is more than that. And it really exposed not only our over-reliance on the U.S. market, but the lack of preparedness of many Canadian organizations to truly expand beyond the North American marketplace. We've long discussed the importance of diversifying our exports beyond the U.S. market, but it's been very inconsistently pursued. And so, while I kind of see it every day in the preparedness of companies to move beyond the North American borders, I think for many, it would be a shock as to how poorly prepared most Canadian companies are. And therefore, it's going to require a lot of work, and diversification beyond North America is going to take some time.
What are some of the big weak points or concerns?
Well, it's a lot of people focus on just acquiring new customers, in international markets, but it's far more than that. There's regulatory considerations of entering new markets. There might be changes to product mix. There's definitely new business models, alternative logistics to enter into new markets. And many Canadian companies have traditionally competed on cost. And while the U.S. market allows, its close proximity, it's relatively low cost to serve as we start moving beyond North America, competing on cost is not necessarily an easy or viable strategy for most companies.
No, it sounds like quality is a big thing we want to watch. Are we seeing companies adjust, though?
We're seeing two types of companies. The study really breaks them down into those companies, which is the majority, which are focused on the North American marketplace. 80+% of their sales come from Canada and the U.S., and then other companies which are already what you'd call global exporters. And so really the major hit is to those companies that are North American focused, as you can imagine, with our biggest trading relationship being somewhat disrupted and uncertain over the last year. Those companies have largely paused what I'd call large irreversible investments, and we see it every day in the news. And so they're looking for a degree of certainty and clarity with the upcoming CUSMA negotiations. Those companies that are already more global have a fairly different degree of operational flexibility. So they're now accelerating investments to get stronger footholds in global markets. So they're moving, right? And it's those companies that have traditionally just focused on the North American marketplace and perhaps had a false sense of security in the U.S. Market. Those are the companies that are going to have to make moves once there's a degree of certainty. Right now, a lot of the big investment is paused.
Everything is on hold right now. I was fascinated by a couple of the numbers. 12%, that's how much our exports have fallen since 2000. And we are one of the slowest growing advanced economies in the world over the last half century.
Yeah, that was really looking at the 2000, to current state, and we've seen a plateau. On a GDP, exports as a percent of GDP, it's been quite flat. So we haven't really grown. We're also one of the most concentrated countries in the world when it comes to export diversification. 75% of our exports are going into the U.S. marketplace. Where if you look at the U.S., they're far more diversified. The U.K. far more diversified. So Canada has been highly reliant on the U.S. marketplace for our exports, certainly of goods, as some of these statistics show. So it's been in front of us for a while. Our dependence on the U.S., the fact that we as a country are not growing our share of exports in the global scale. Our economy has been relatively flat in comparison to others that have been performing strongly. So this is a bit of a wake-up call, I think, and the government, and businesses are taking it as a shared priority to diversify Canada far beyond North America.
And now you have the Prime Minister who's been jet-setting around the world trying to develop new relationships. Now he's down in New York. Are they having an impact, any of these meetings that you can see, or no? Is it still too early?
Well, it will take time, right? So the immediate impact is not felt yet. I think what our interviews and our surveys indicate is that companies in Canada are looking for the government to do exactly what Carney is doing, which is not only establish trade relationships with other countries, but to remove non-tariff barriers as well to give us better access, to these markets. The challenge for many companies is it's not been for a lack of ambition. It's been from an inability to execute. And perhaps, with scarce resources, the U.S. was a huge and attractive market, and all the priority was on that market. What we're talking about now is building a capability that allows Canadian companies to expand beyond the U.S. The trade deals, the policy, the government incentives, that's all really important, but it's going to be Canadian companies and their ability to execute that ultimately changes the game.
That was Jim Kilpatrick, Global Supply Chain and Network Operations Leader at Deloitte. Well, Prime Minister Mark Carney is heading to New York to drum up business and investment for Canada. We'll find out more on that after the break. We are watching shares of Pembina Pipeline today. The company is going ahead with a new natural gas processing facility in Alberta. The Heartland extraction plant has an estimated cost of about $570 million and an anticipated start date in late 2029. Following extraction, Pembina says the ethane mix will be processed at its Redwater complex, as well as Dow's Fort Saskatchewan facility. Uber is offering to take over Delivery Hero in a deal valuing the German-based company at more than $12.8 billion US. Uber already owns 20% of the food delivery company. However, the proposal offers no premium to its most recent closing price. This may create an opportunity for rival bids, with DoorDash expressing interest in the company as well. Investors believe a higher price will be required to close the deal. And Pope Leo is urging governments to slow down the development of artificial intelligence systems. In a landmark address to the Catholic Church, he says AI should be disarmed to protect humanity from its dangers. The Pope is calling for making AI more human-friendly, and he also warned that AI spreads misinformation, prioritizes conflict, and risks leading the world down a path of unending war. We're watching the TSX today. It is making some pretty significant gains, up by 0.8% at the moment, led by the materials index today, followed by infotech and then industrials. We'll continue to watch that for you throughout the day. Let's head to Ottawa now, where CTV's Mike Lecouture has the latest on Parliament resuming for its final session before a summer recess and before Prime Minister Mark Carney heads to New York to pitch Canada as a good investment. And Mike joins us now. So Parliament reconvenes today for a short while before the summer recess. What will be the main focus, do you think?
Yeah, it's interesting, Lindsay, because so far today, the main focus has been anything but what's happening on Parliament Hill. A lot of questions about the question on a question for the referendum out in Alberta. That is what Prime Minister Mark Carney was grilled about today when he met with the media at a building site. And he warned that this whole issue and whether or not Albertans are bluffing, he says it's a dangerous bluff if you think that you can essentially ask a question in order to get a little more negotiating leverage with the Federation or with the federal government. And he basically pointed to Brexit, which of course he would have a lot of experience with as he was the Bank of England governor at the time, and saying that is not how this is going to work this time. He was also asked about whether or not it made sense to ask this question, and he pointed to the fact that this was not in any political platform during the last Alberta election, and saying that it is unfortunate that it is being asked at this time, and he doesn't think that this was something that voters want. At the same time, while all of this has happened, you go all the way over to Alberta and Kananaskis, where you have the premiers, the Western premiers, and the territorial leaders, or the premiers of the Northern Territories, that are all gathered together. And of course, the question on separation could be an awkward moment, as well as including the whole conversation between Premier David Eby of BC and Danielle Smith of Alberta when it comes to the pipeline. We know that the two of them are not on the same page about this project when it comes to moving Alberta bitumen to the west coast of BC, especially on any kind of route. So it could be some awkward moments there as well. But certainly that question continues to spill over here in Ottawa, when you consider the fact that this is the return of Parliament for a few weeks before they go on summer break, but a lot of legislation that they still have to pass.
Yeah, and Mike, we know that the Prime Minister heading to New York this week will be meeting with investors, CEOs, business leaders. This obviously comes a couple weeks before the CUSMA renegotiations start. What do we know about that trip and what we're expecting to come out of that?
Yeah, it will be a big pitch to the Economic Club of New York in terms of Canada being a place for investment. He wants to make sure that he continues to pitch Canada as an energy superpower as well. I mean, we know, and you've spoken to a number of CEOs who've talked about this, while all these tariffs are in place and while there's all this uncertainty around the trade war between the two countries, companies just aren't investing, and they are sort of weighing their time and biding their time to see what exactly will pan out. So Prime Minister Carney trying to go down there to speak to investors, to speak to CEOs and say Canada is still a good, stable place to invest, and wanting to be that energy superpower as well. You talked about CUSMA, 37 days until July 1st. That, as a lot of people know, is the day by which all three countries have to notify each other whether or not they're deciding to go forward with this agreement. In the meantime, we are hearing that Mexico and Mexican and American officials are progressing rather quickly with their negotiations. Well, it's radio silence from Canadian officials at this point. So that may be another thing we're looking for, any kind of clue from the Prime Minister that he's going to send to this business crowd as to what is going on and what Canada's intention is going forward with the trilateral trade agreement.
For sure. Okay, watching for that. That's CTV News. Mike Lecouture joining us live. Mike, thanks for that. Appreciate it.
Thanks, Lynn.
Oil prices have dropped after the U.S. and Iran signaled progress toward a possible deal to extend a ceasefire and reopen the Strait of Hormuz. We'll take a closer look at that right after the break. Stay with us. Oil prices have pulled back as the U.S. and Iran signaled progress toward a ceasefire extension and a potential reopening of the Strait of Hormuz, though key issues remain unresolved. The conflict has already shaken global supply chains, fueling concerns over slower growth as trade costs rise. For more, we sat down with Paul Harris, portfolio manager at Harris Douglas Asset Management.
My issue with all this stuff is that have you made the kind of world or the Middle East safer because of all this stuff, right? And it just appears to me you really haven't. And you've got sort of your neighbors, the Middle Eastern neighbors, kind of worried, and your allies in that area. You've really not solved anything, and you've emboldened Iran a lot more than you probably could have before. And
but also, have they taken out capacities for Iran, military capacities?
Well, I mean, clearly they have.
And have they pointed out that maybe it was a danger, a legitimate danger?
Well, I mean, don't get me wrong. They should not have nuclear weapons. That's very clear. And I think the allies in the region really believe that. And they need to stop kind of supporting a lot of these other regional people that cause a lot of problems, whether they cause problems to Israel or cause problems to other parts of the world. I totally agree with all that. But I mean, I'm not sure you've solved any of those problems in the present situation. And I think that, the Taliban used to say this thing that Americans have watches, we have time. And that's the problem, right? They have time on their hands. And so I think that that's the reality, is that they can wait this out. And I mean,
can they wait it out if their oil's not getting through?
Maybe not, but I mean, they can suffer a lot more than I think a lot of other people can. They're already suffering. I mean, they were suffering before we started all this stuff, or the Americans started all this stuff. So I think that it's not really, their economy's been in recession for a long time. So I think it's not the fact that that's not the easy route out, because you can say, oh, well, they're going to suffer and they're going to give in. That's probably not the case there. So I'm not sure. Like, it's just hard for me to figure out exactly what's going to happen, right? And whether they open up the straits, whether they kind of make it more accessible for other people, whether they're going to charge a toll, who knows? And whether they're going to get rid of all their enrichment. It's not clear that any of those things are going to happen, or are they going to happen in a timely manner that makes, that area safer. And I think that's kind of was the goal, to try to make it safer. And I don't think it is. It's presently not safer today than it was before.
Absolutely. I think there's no
that's
no
the
argument
issue
on that. I guess what happens next is a big thing. And you also you say bigger picture. There are concerns, like this has opened up. This is just the latest shock.
Yeah. So there's been several shocks in the economy, whether it's the Ukraine war, whether it's whether it was COVID and all this stuff, and it's really created this real problem about supply chain. We had this global world where the goods moved around very freely. We had no kind of tariffs were very low, and the idea that globalization was an important product of a world that's growing, but that's kind of stopped. And so that's had I think it's having, and the world is still fragmenting even more. And I think that this issue where you have access to supply is changing quite rapidly, and it has real implications, especially if the world slows down, that you have to have supply chains in two places, so you're duplicating costs. So yes, the issue becomes, do you want to lower risk and have insurance? But insurance always costs you money. So there's the lower the risk of having supply chain in the United States, that's fine, but you're increasing the cost of everything. And so this idea that we're going to have to duplicate supply chains, we're going to have other ways of doing it, that globalization was, is not working in the way we thought it should be working, is going to have, I think, deep implications for the global world and the global economy as these things continue to fragment.
But do you think this is something that's going to stick? I mean, one of the big things in the pandemic was medication,
right,
and PPE.
Right.
We weren't getting PPE shipments. Right. We were going to start our own. Have we done that? Have we created facilities that make all that, facilities that create the meds that we might need as well, that we're having manufactured in China and elsewhere? Right.
So I think the issue was that we felt that, the pandemic's over and things are going to get back to normal. And we've seen kind of since then even more fragmentation in the global economy, right? So I think people like Canada and Europe and all these other places are realizing that no longer can they rely on America or other parts of the world for the things that they want. And the world is being divided up into three places: China, U.S., Russia, and they have to kind of survive in their own way. And that means, like you saw Japan do a deal with Australia on minerals. You've seen, other parts of the world, even Canada doing other deals with other parts of the world that they wouldn't have normally done in a situation that we believe that the world was going to be thinking about it globally.
But is it a bad thing, though?
It's not a bad thing, but it creates a lot more cost and it creates slower growth, I think, in the long run. Because globalization, whether people hated it and all these other things, there were all kinds of bad parts about it, but there were also many good parts about it. It really helped show better economic growth. And, kind of the idea that Adam Smith came up years ago that if you have a competitive advantage in producing a particular product, you should go do that as opposed to I'm doing that where I don't have a competitive advantage. I mean, and it did hurt certain parts of the sector here. Like we had a textile sector here that disappeared effectively in this country because, you couldn't produce a T-shirt for
the price that you can in Indonesia
$5,
or somewhere. Yeah.
Right? So I think that, and it did make a lot of sense, but I think that, that free trade is really kind of like a car goes back and forth. So there are benefits to it. I think that the problem is that if you're duplicating all those things in your country, again, you're going back to being very, very inefficient. And in some ways, you're not taking advantage of the fact that someone in Mexico can produce this product just far cheaper and better, and the quality is just the same, and you can import it and actually use it effectively. So I think that you're going into a world where those fragmentations are going to cause you to make different decisions, but they're also going to duplicate costs. They're also going to increase increase inefficiencies and lead to, I think, slower growth because of that.
That was Paul Harris, portfolio manager at Harris Douglas Asset Management. Well, investor attention turns to the banks as the Big Six are set to report later this week. We'll get more on what to expect when we come back. It is a big week for Canadian banks with all of the Big Six reporting later this week. Bank stocks are up 16% so far this year, while the TSX is only up 9%. For more, we were joined earlier by Alexander McDonald, portfolio manager at Focus Wealth Management.
We have BMO, Scotia, and National reporting before the open on Wednesday, and the remaining three of the Big Six reporting before the open on Thursday. As you mentioned, they've had a great year. That has caused valuations to expand a little bit, though. They're up as a whole, trading at just over 15 times forward-looking earnings versus the 10-year average of about 11 times. That's the group, but within the group, there's actually a bit of divergence from the low end of 13 times up to the high end of just under 17 times. And what's driven that divergence has been the nuances of the businesses that the banks are participating in to greater or lesser degrees than their competitors. So there's two main businesses that I think are going to be topical this week as the banks report. The first one is capital markets. That's been a huge tailwind for the banks, not just over the short term. 25% of earnings revisions recently have come from the capital markets side of things, but over the long term. Since 2019, the capital markets business has grown 10% annually for the banks. So banks that are overweight the capital markets side, National comes to mind. They have done especially well recently, and National is actually at the high end of the valuation within the peer group. The other big part of the bank's business that I think is going to be topical this week is on the consumer lending side, specifically personal lending in Canada. The Canadian economy is doing okay. It's not doing great. We're starting to see unemployment tick up right around 7% now. We're starting to see credit card delinquencies tick up. Consumer proposals are increasing a little bit too. Of course, the housing market is down about 20% from its 2022 highs. So with energy prices increasing from what we've seen with the conflict in the Middle East, it's going to be interesting to hear what bank management teams are saying about the environment, saying about the lending environment to Canadian consumers. I think we're not going to see for the next little bit significant mortgage growth because of those headwinds that I mentioned earlier, but we might see net interest margins expand at the banks as that yield curve steepens and they can lend out their mortgages at a higher rate than what they have to pay for deposits on the closer side of the yield curve. So those are two things I'm going to be looking at this week, and we'll find out in a couple days what is topical from the bank's point of view.
And just going back to the capital markets, you said National's really benefiting. Any of the banks not doing as well in that sector, and are any potential headwinds there?
Yeah, National, as I mentioned, they're overweight specifically on the equity and derivatives trading side compared to some of the other banks. So traditionally, the banks were very strong in fixed income, commodities, and currency trading. That shifted in recent years. Since 2019, I mentioned that overall capital markets revenues have grown. Equity capital markets has actually grown at about 12%, and that fixed income side has only grown at about 9%. So because National is more overweight, the equity side, you've seen that stock do very, very well. The downside of that is capital markets revenues can be very volatile. We know, looking back over the last 3 months, that we have seen volatility in the equity markets. So that's good for the banks and their capital markets business. But that doesn't last forever. If we do have periods of lower volatility in the markets, that won't benefit the bank's capital markets, specifically the Nationals of the world that are exposed to the equity side of things as much. So in one of the two names that we own at Focus, I can talk to in a little bit, they're a little bit more underweight the capital markets side of the business, and a little bit more diversified, and that's Royal, and we can chat about that in more detail.
All right, well, let's talk a little bit about Royal. I mean, it's the beast, it's the big one, isn't it?
Yeah, so it's actually been a bit of a laggard, even though 3 out of the last 4 quarters it's beaten on ROE compared to what analysts were looking for. And the reason it's lagged the Nationals of the world is because it is more diversified with its business model. It is generating those high ROEs, but it's not participating in the upside on the trading side as much as some of its competitors. That said, I did mention that capital markets revenues can be volatile, and I think if some of that activity does come off, some of the shine comes off some of the banks that are more exposed to that, you might see investors gravitate back towards an RBC, which does have a very good diversified business model across lending, capital markets, the corporate banking as well too. Its valuation is on the higher end of the group, but National is still trading higher than it. And we think it's at a reasonable level right now, and we're happy to hold it over the long term. And
Bank of Nova Scotia, it's doing a strategic reorientation. What are you going to be looking for with that this week?
Yeah, Scotia's the other of the big 6 banks that we own. As you mentioned, a bit of a strategic reorientation. New management team came in a couple of years ago to really focus in on the North American market. It was previously pretty well diversified across Latin America. But more recently, it's really had a laser focus on its Canadian lending business. If you look at the ROE, the return on equity it's generating there, it's about 16%, which is below management's target of 24%, and the peers as well, they're up around that level as well too. So Scotia's been very, very focused on making that a priority to get that Canadian banking segment in better shape. You're starting to see some green shoots there. Their fee-based income on the Canadian banking side has increased in recent periods. As well, management has said they want to be more aggressive bringing on new clients. Obviously, it's a very competitive market, but you got a lot of borrowers that have ultra-low rates from the 2021 cohort when mortgage rates were super low that now have to renew in 2026. So those are potential new customers that Scotia can go after and increase their loan book that way. And in addition, its valuation, that's part of the attractiveness with it too. It's just trading over at 13 times, which is the lowest of the group. And we think that is a reasonably cheap valuation for a bank the quality of Scotia's.
All right, I just want to get one last question with the fintechs like Wealthsimple, Questrade. Concerns from the banks there? Are they taking a bigger bite of the pie?
Look, it's great I'm a Canadian, it's great from a consumer's point of view to have more competition out there in the financial industry. It's good to see somebody going up against the big banks to make them evolve and innovate with their offerings as well too. You start to see the products that banks will offer you will mirror Wealthsimple if you see Wealthsimple taking customers. Over the long term, I don't think it's going to take a huge bite out of the bank's business. I mean, it's an oligopoly. It's been an oligopoly for the longest time. Incredibly strong banks. They survived the financial crisis in 2009 when U.S. banks, a lot of them didn't. It's a pillar of the Canadian economy. They will innovate. They'll make things better for customers, but I don't think it's going to be a material disruption going forward.
That was Alexander McDonald, portfolio manager at Focus Wealth Management. Okay, let's take one last check at the markets, particularly the TSX, to see how it's faring today. Of course, this is a U.S. holiday, so we're not going to be checking in on U.S. stocks, but the TSX has hit another fresh all-time high today, up more than 340 points, with 9 out of 11 sectors in the green today. When we take a look at some of the biggest stocks on the upside today, obviously the materials sector is leading the TSX. So we're seeing America's Gold and Silver up by more than 4%, Aya Gold and Silver up by almost 7%, and Montage Gold Corporation up by more than 6%. So we're seeing materials leading the gain here, of course, because the price of gold is up today, because there's talk that maybe the Strait of Hormuz will be opening soon. We're seeing some of these companies benefiting from that. On the flip side, some of the biggest stocks on the downside on the TSX are some of the energy stocks. Athabasca Oil down almost 5%, Baytex Energy also down almost 5%, and Tamarack Valley down more than 4%. Obviously, we're seeing the price of oil dropping today again because there's talk that maybe this conflict in the Middle East will be wrapping up sooner rather than later. And so we're seeing some of these companies, particularly within the energy sector, reacting to that. That wraps up this edition of Trading Day. Thanks so much for watching.